Hello, let us look at depreciation. And depreciation is spreading of the cost of a non-current tangible asset over its useful life. Okay, note that here we are talking about tangible asset because for non-tangible asset we use amortization. Okay, for example, when we have an accounting software that a business is using, we are going to use amortization because it is a non-tangible asset. Okay, and there are two main causes of depreciation. There are many others, but these are the main causes of depreciation, which is wear and tear. For example, when we have a motor vehicle, when you use a motor vehicle for a period of time, you're going to notice the tire is wearing off, the engine also wears off, okay? So as you use something, it wears, okay? Then the other one is obsolescence. This happens when there is an introduction of new technology and that this technology makes the other asset lose value. For example, when we had the typewriters and then came the advanced computers and the laptops, so the typewriter had no longer had value. Okay, so those are some of the causes of depreciation. Now let us look at some of the main terms you're going to find on depreciation. Then the first is the cost of asset, which is the total amount you spent to acquire that asset. So for example, if you buy a motor vehicle, the cost of that motor vehicle and also the amount you've used on the import duties and the levies is also included in the cost of that asset. Also the carriage inwards, that is the amount you use in the transportation of that vehicle from the origin to your business, that's also included in the cost of the asset. If it is a manufacturing plant, even the installation cost is included as the cost of that asset. Okay, now the other one is estimated useful life, which is the period which an asset is expected to be used by a business. So if I have bought this car and I'm using it in the operations, or maybe I'm in logistics, so moving things from one place to another, then I'm able to estimate, okay, so I can only use this motor vehicle, let's say for example it's a lorry, for a period of 4 years and still effectively past that years that I will not be effective use, it will not be effective to use this asset. So usually estimate the useful life of this asset to the business. Okay, and then the other one is estimated scrap value, which is also known as the residual value. And this is an amount an asset is expected to be worth at the end of its useful value. So this is the amount that you dispose this asset. So at the end of these 4 years, for example, I bought this lorry at 4 million. Its residual value could be 1 million or less. Okay, now let us look at some of the main methods of depreciation, some of the methods that are used to depreciate an asset. And the first one is straight line method, where basically same depreciation is done on an asset every year. Every period in its useful life, we depreciate the same amount. So if it's first year we depreciated 10,000, second is 10,000, third year is 10,000. Okay, so this is basically how we calculate it, the cost of that asset minus the residual value over the useful life. Okay, now let us look at an example. We have the cost of this motorcycle as 110,000, and the residual value is 10,000, and the useful life is 4 years. Okay, so we are going to have this is 100,000 divided by 4. Okay, so we are going to have a depreciation cost of 25,000. This will be the cost for this depreciation. For this, the depreciation cost for this asset will be 25,000 the first year, and also till the end of its useful life. You're going to realize we are going to calculate the same way, which is different from what we are going to look at, which is the reducing balance method, because here we'll still calculate the same way, and you're going to see that the depreciation expense will still be 25,000. Okay, now when we compare that with the reducing balance method, where there is higher depreciation in earlier years and then it goes as it reduces. How? Because the depreciation of when using reducing balance method, the depreciation expense is depreciation rate times the net book value. Okay, so let us look at an example to understand. So for year one, we are told our cost of asset is 100,000 and the depreciation rate is 20,000. So we are going to have 20%, 20% of 100,000, which will get a depreciation of 20,000. Okay, this is year one. And what will be at the beginning of that year, this is our net book value because we bought these assets during that year. So at the end, our net book value will be 100,000 because now it's we are reducing the depreciation expense. We are going to have 80,000 as our closing net book value for this asset. Okay, so what will be our year two? What will be our year two depreciation? It will be 20% of 80,000. 80,000. So you're going to see we are going to have 16,000. Okay, and the same happen. Our net book value at the end will be 80,000 minus 16,000. Okay, so you're going to notice that the net book value will continue reducing, and the next period we are going to depreciate on the net book value. That is why we are saying that there is higher depreciation in early years, and then with time it goes as it reduces. Okay, now let us look at the other that common used method of depreciation, which is called the units of production method, and it is based on usage and not time. Okay, and this is where you look at an asset, you're like, this asset can produce this number of units before to be effective to the business. Okay, so we are basing the usefulness of it not over a period of time, but rather the total units it can produce. Okay, so the depreciation will be the cost of that asset minus the residual value over the useful units. Now, not the useful life, but the useful units multiplied by the number of units it has produced for that period that we are looking at the depreciation expense. So for example, we have a machine for drilling water boreholes that was bought at 1 million, and the useful units that it can produce is 50, and we have during the year the boreholes dug were 10, and we have the residual value as 200,000. Okay, so our cost is 1 million, the initial cost. Our residual value given is 200,000. Okay, and the useful units, these are units that it can produce. We've checked and seen, okay, by the time after we produce these units, then it is not going to be effective to use these assets. Okay, so we have 50 boreholes. Okay, and then this is basically like the depreciation rate in this instance. Then after getting that, we multiply by the number of boreholes that have been dug during that period. For example, if this was the year 2025 and we dug 10 boreholes, then this will be our depreciation expense for that period, which will be 800,000 over 50 times 10. Okay, so 10, then 5, we get 16. So we are going to have a depreciation expense of 160,000. So this one, it is based on the number of units and not time. Okay, so stick around as we are going to discuss further on how does the depreciation affect profit, how does it affect the balance sheet, and basically the statement of profit or loss, and why it is very key in terms of accrual accounting, because we need to match revenue to expenses. Okay, and that's all for today.